Now, here are our accounting qualities. Lots of free points will come on the exam from this. So the fundamental qualities of information, all the info we have presented in our financials, we want it to be faithfully represented and relevant. All of our info, well, we're not going to put anything on the financials unless it's relevant, right? Unless it's relevant for making a decision, unless it's going to help you make a decision, right? So it's important to know how much debt you owe, how much cash you have on your balance sheet, and faithfully represented. This just means it's correct, right? It's not being lied about. No one is misleading you. And now the ingredients. So a question might ask you directly, well, what is an enhancing quality? Okay, and you got to pick one of these. Or what's a fundamental quality? And you got to pick one of these from other possible answers. That's where easy questions might come, but also understanding these and what they are is important as well. So the ingredients of the fundamental qualities, we've got under relevance, predictive value. Well, it's relevant if it can help you predict how the company is going to do in the future. If you've got a lot of debt on your balance sheet, you might predict that the company might not survive another few years because it's got so much debt. Confirmatory value, you can confirm it's true, it's relevant, right? It is something that is accurate. And materiality, well, this is one you're probably familiar with, the concept of materiality. We're not going to report a $100 theft on a company if the company is a $100 billion company. It's not worth our time, right? Yes, technically, like it should be recorded somewhere, but it literally is not worth our time. It just would not help us make a decision to invest in a $100 billion company, nor would a misplacement of cash or an overstated debt of $100. That's just not relevant. Hey, relevance right there. All right, enhancing qualities. How do we enhance? Well, comparability. We want to be able to compare year 1 to year 2 to year 3 and year 4 and etc. We want to make sure that we see how the company, because if each year's financial statements follows different rules, well, then that kind of messes with us, right? Because we really can't compare them. We don't know if the company's improving or declining. Verifiability, that one's pretty straightforward. We want to make sure that everything we see, we can verify, and it is accurate, it is true. Timeliness, well, if we don't get the financial statements in time, then we're at a loss. We're kind of screwed. We can't make a decision in time. And understandability, this is what we talked about before, the reasonable person. We want to make sure a reasonable person can understand the financials. As I was saying, faithfully represented means basically that it's true and that management is doing their best job to faithfully represent the financial statements to you. And how do we do that? Well, is the information complete? Are we missing anything? Hopefully not. Neutral, right? Neutral, free from bias. It's not being skewed in any way that makes it sound better, right? Like, because it could be true, but if it's biased, it could be like just with data and surveys and things you see in the real world, the data could be true, but you could be skewing it to seem like something else. And then free from error, this one is straightforward. It is accurate, right? No errors, reasonably, right? I mean, sure, there might be an error here and there, but that is what reasonable assurance is with audit.